Greetings, this is going to be another CrashWatch video and a continuation of the points that I discussed in the previous CrashWatch video 2 weeks ago. That was a longer and more detailed video, so I won't repeat a lot of the same points over there. I will just refer you to that video. And you can see that in this tile up here in the upper right hand corner, and it will also be in the end screen of this video. So we take the S&P 500 1-year chart. SPY is the ETF for the S&P 500, and this head and shoulders pattern is nearly complete. A head and shoulders pattern is one that doesn't happen very often. It only happens once every few years and is usually a very high correlation indicator of a major stock market correction. You have this left shoulder, which was a record high, that corrects to what is known as a neckline over here. Then it goes to a head, which is a new record high, and the head is larger than the left shoulder. That corrects to the same neckline, and then you have the right shoulder, which fails to make a new high, and that's why it's called a shoulder, because it doesn't get as high as the head. And when that fails, it starts to test the neckline again over here, and when it breaches the neckline, then it can plunge really far. Now remember, the Russian invasion of Ukraine happened over here in late February, early March, and that was when the shoulder was forming, so that did dip below the neckline but sprung back pretty strongly because the market wasn't ready to correct quite at that time. Had things escalated further, yeah, that would have overpowered whatever timing was unfolding with the S&P 500 dynamic itself. However, this is the neckline that is now being tested again as of April 22nd. And the duration of this right shoulder doesn't have to be exactly the same as this left shoulder, but it often is. So this is a neckline and right shoulder formation. So many things are very poised for a substantial stock market correction, even an outright crash. Now this is the 1-year chart. If you look at a 5-year chart, you'll see a broader perspective. It was rising, and whenever quantitative easing was stopped by the Federal Reserve, there was a correction and then a threat of a recession, and the Federal Reserve was forced to print more. And those of you who are familiar with this channel know that my thesis is that this money printing has to rise exponentially because the stock market demands more and more of it, because technology is diffusing into a larger and larger portion of the economy, and more of the S&P 500 becomes high tech. It's not merely that tech stocks are becoming a larger and larger percentage of the S&P 500, but even low tech companies are infusing more technology into their businesses. And the overall PE ratio, especially the forward PE ratio of the S&P 500, continues to rise. Therefore, the inherent assumed growth rate of the broader stock market continues to rise. So this huge increase over here was because of the amount of money printing done in response to the COVID-19 crisis. But now the Federal Reserve is trying to undo all of that. They went from doing $120 billion a month of money printing to not only stopping that, but going in reverse to the tune of $95 billion a month and raising the Fed funds rate. So they're really tightening extremely quickly. There's never been a tightening of this speed before. Why? Because there's some brief inflation that they believe is a much bigger problem than causing millions of people to lose their jobs. And that is a particularly poor assessment of the situation, given that inflation is not the fault of the Federal Reserve. It is because domestic oil and natural gas production has been stopped by the United States, and that has caused the price of oil and natural gas to rise, which then emboldened an oil and gas producing dictatorship like Russia, so that they get the courage to invade Ukraine, which they've been waiting to do for 8 years. The last time they did that was 2014, but oil prices were too inexpensive, so they couldn't do that. And now they're doing it, driving oil prices up further, but baking in future demand destruction of oil very quickly and ensuring that the price of oil will plunge pretty far in the medium to long term as a result. But with this chart and the head and shoulder pattern and the big run up we've seen in the S&P 500, a correction down to here, the low 3000s, is certainly quite possible. And that would still be a record high as of late 2019. However, that's a big percentage drop from now, and a lot of the high beta tech stocks and a lot of recent wealth gains will be very quickly reversed. A lot of home equity gains that have accrued in the last 2 years will in fact be reversed. Now, this is in addition to the oil price pressure on the S&P 500. So add the oil ETF, USO, and go to a 1-year chart on that. So the S&P 500 looks mostly flat compared to the oil rise, but oil has risen this much. And this is a huge cost to consumers, to businesses, and the ripple effects of this are still working their way through the system, and that's going to eat away earnings of the S&P 500 and put downward pressure on the S&P 500 as well. Remember, this first part was because of the stoppage of domestic oil and natural gas production in the US, and this big spike after that was because of Russia's invasion of Ukraine. So now we go to the list of points that I detailed in the previous CrashWatch video for a quick review. Reasons for an S&P 500 crash. Head and shoulders pattern in S&P 500 chart, so we just looked at that. High oil prices reducing corporate earnings and consumer spending, we just spoke about that. That is something that eats away at the earnings of companies that comprise the S&P 500 and therefore reduce the extent to which their earnings can grow and cause the stock market to crash. Federal Reserve rapid quantitative tightening, entirely unnecessary. It is something that they will quickly reverse once the stock market correction becomes too severe. But they just never learn their lesson. They print a lot and then try and reverse the whole thing because they still think the entire balance sheet can be unwound. That they can go all the way back to undoing all of the last 12 years of quantitative easing. And under atom principles, which I speak about all over the place on this channel, we know that's not the case. And this should be embraced as a new reality, that you can print a certain amount that rises exponentially forever without creating aberrant inflation. But they don't get it, so they're going to cause a lot of extremely unnecessary turmoil and pain to people, because they still believe that all prior money printing has to be undone. You cannot just keep undoing this and expect that prosperity can return. I guarantee they will be forced to do much more than they were ever doing before, because they've already tried this 5 times. I repeat, 5 times with the same result. And of course, the definition of insanity is to repeat the same thing again and again and expect a different result. But PhD economists like to follow models from the mid-20th century, and when reality conflicts with their model, they would rather ignore reality because they're hyper-theoretical people. I say that all the time. But we are now on the verge of seeing that manifest in a very real and very destructive way for people. And the last is their tightening also increases interest rates, which is going to put downward pressure on housing prices. The next several years of forward home buying has already happened because of the all-time low interest rates, which we speak about in other videos, including this one over here that you see in the tile in the upper right-hand corner. And this is going to work as a compounding effect to the fall of the S&P 500. And the two in tandem are going to greatly increase the chances of recession, which can be reversed immediately if the Federal Reserve stops tightening. But the Federal Reserve will let it get pretty bad first, because they believe having a large balance sheet is more of a problem than millions of people losing their jobs. So we're definitely on a crash watch right now. The S&P 500 is on the verge of a major correction, just like it was in the prior crash watch videos. But since 2 weeks have passed, I thought we would do an update about that. These are lessons that are also going to be valuable years after this video was posted, because it's not only about short-term news, it's about understanding how to evaluate various factors that affect the stock market and using that information to make your own decisions about what you may or may not want to do regarding investment rotations, entry, exit, things like that. I hope you found this video to be informative, and if you like this type of content, I urge you to subscribe to this channel. Thank you very much for watching.